Hello everyone, thanks for checking out my video. Wow, what a stormy February we had. Volatility gripped the stock market throughout the month as all three major indexes wrap up the month of February with sharp weekly and monthly losses. The S&P 500 and Dow Jones saw a decline of around 1.5% for the month, while the tech-heavy Nasdaq dropped close to 4%. This was the tech-heavy's index worst month since April 2024. The losses came after a series of tariff moves, hot inflation data, and political drama. In addition, there was also a sell-off in Bitcoin as it plunged to its lowest level since November last year. The cryptocurrency has fallen more than 20% from its record high. This is its worst monthly performance since June 2022. It seems like we currently have lots of fear in the market, as you can see from this fear and greed index. So just when everyone was fearful, I bought the dip and opened a few bullish option trades. Want to find out more? Watch on this video. Alright, the US stocks managed to rise last Friday to wrap up a volatile week and a losing month for the major indexes. Let's very quickly break down the key events that happened last week. On Thursday, Nvidia's share price plunged more than 8% after its earnings and forecasts failed to impress investors. The sell-off had wiped out about $273 billion in market value. The company's less than impressive market outlook has also dragged down the other AI-related mega-cap companies such as Meta, Amazon, and Google, as they all pull back by more than 2% on that day. Unrelated to Nvidia, Tesla had a very poor month as the share price tumbled close to 30% in February, clocking its second worst month ever. The plunge was likely caused by a series of negative headlines for the company and its CEO Elon Musk. Many investors believe that Elon Musk's political baggage is now weighing on the company's sales, brand loyalty, and investor confidence. Speaking of political stuff, last Friday the world witnessed a geopolitical drama playing out in the White House as US President Trump and Ukraine President Zelensky had a heated exchange in the Oval Office. This has raised concerns about heightened geopolitical risk. Okay, but fortunately, the January reading of PCE index has perhaps done its part to ease some anxiety on Wall Street about a slowdown in the economy and an uptick in inflation. The annual core PCE figure, which is the Fed's preferred measure of inflation, came in line with analyst expectation at 2.6%. This is a decline from the previous month of 2.9%. Okay, whether is it the cool heads took over the market towards the end of last Friday, or was it some end of the month portfolio rebalancing actions, investors must have felt relieved to see major stocks rally pretty sharply into Friday's closing hours, sending February off with a relief rally. Okay, let's look at what's ahead for the upcoming week. First up, tariffs. Trump said that the 25% tariffs on imports from Canada and Mexico will come into effect on 4th March instead of 2nd April. He also mentioned that goods from China will be subject to an additional 10% duty. On top of this, Trump also threatened to impose 25% tariffs on imports from the European Union. So the market will likely continue to be the subject to this tariff volatility for the week ahead. At the end of the week on Friday, 7 March, investors will have monthly jobs data to digest. The stakes are high for this report as a number of recent economic reports have already disappointed or weakened, including consumer confidence, business activity, and retail sales. Wall Street will assess whether the latest jobs report is going to contribute further to the series of economic indicators that point towards a slowing US economy. Okay, amid the heightened volatility, from a technical perspective, there is a decent possibility that the market could tread sideways or have a small bounce in the upcoming week. Which brings me to the next segment, technical analysis. But before that, just wanted to say, this bet will be caught off if the geopolitical tension or the tariff war gets heated up. Alright, let's now jump over to the technical analysis section. First up, SPY. In my last video, I shared that if SPY loses the 50 moving average, it could slide further down to the 61.8 Fibonacci level. And if that gets broken as well, we can expect the gap between 585 to 589 to be filled. Ladies and gentlemen, SPY went as low as 582.44 and really filled the gap entirely. Sounds very bearish? Okay, here's a saving grace. SPY rebounded after filling the gap. Not just that, it reclaimed the important 61.8 Fibonacci level. So for this week, watch this 61.8 Fibonacci level at 590 again. If it breaks again, then the trend is still bearish. Below 590, watch out for that green support line, which roughly sits at 583. This is a resistance turn support level. In fact, we bounced off this level last week, and if this support level breaks as well, I think 575 could be in sight soon. On the other hand, for SPY to reverse its bearish trend is an uphill task, but if I were to summarize it, there are basically two key levels to watch. The first one is the 50 moving average at 598. The second level to pay attention to is the 23.6 Fibonacci level at around 604. Given how volatile the current market is, I would think we can expect some form of resistance at these two levels. But if somehow SPY can close above both levels, I think we could see a new all-time high soon. Moving over to Apple. Wow, for Apple, if you could recall, I specifically shared in my last two videos that my thesis of Apple hitting 250 is still intact. Look at the chart, Apple hit exactly 250 before retracing. I hope that could earn a like button from you. Anyway, Apple looks a little tricky at the moment. Let me share with you why. So, Apple went above the 61.8 Fibonacci level, held on for a week, but came back down, so that's not a great sign. But then, Apple then bounced off the important blue support line at around 237 and reclaimed the 50 moving average last Friday. That's actually a good sign. So you basically have the good and not so good signs in just 1 week, therefore making the chart a little tricky right now. It's like the bears have stepped in to push the price down, but the bulls defended well. It's a bit of a tug of war now. To add on to that, the MACD is about to have a bearish cross but have not done so, and whether the bearish cross will happen this week or will it do a reversal, it remains to be seen, and in fact we should watch it closely. If the MACD crosses down and Apple loses that 237 support line, I think there is a decent odds that we will see 220s range again, and I would love that because it gives me opportunity to sell put options. On the other hand, if the MACD reverses and curl back up and Apple can close above 244 again, which is where the 61.8 Fibonacci level is, then I think we will go higher than 250 this time. Let's now have a look at Tesla. Wow, 13% drop in the last 1 week, 23% drop in the last 1 month, and a 40% crash in share price from its peak. How bearish can Tesla get and how low can it go? By the way, a number of videos ago, I drew this green box and I mentioned that I will consider picking up some shares if Tesla drops to this level. Back then, it seems like it's a long shot, but look at how far we have come and how much Tesla has fallen. We are basically back to the pre-Trump victory level. Just to add, last week I also mentioned that the bears were smelling blood and Tesla really plunged. Again, I hope that can earn me a like button. Okay, honestly, this recent huge drop doesn't and shouldn't come as a surprise. I have shared this before, that sentiment-driven rally is not sustainable. We need fundamentals to drive the share price up. Anyway, despite last Friday's bounce, Tesla is not out of the woods yet. For the bearish thesis, I would say watch that 200 moving average like a hawk. If Tesla loses it and loses the green box as a support zone, whether you believe it or not, I think the chance of the top gap getting filled is very high, which means we could see 250s range. And if we don't bounce back up after the top gap is filled, I do think the second gap will act as a magnet and start pulling the share price towards it. The range of this bottom gap is between 218 and 238. Again, I repeat myself, watch that 200 moving average very closely this week. Okay, for Tesla to reverse this very bearish trend, it has to get above 2 key levels at least. Sorry, give me 30 seconds again. If you would like to support this channel and are looking for a new brokerage account, do consider Longreach. Got to be honest, each sign up using my referral link will earn me some referral fees, but the users have to deposit at least 2,000 Singapore dollars before I can earn anything. As for the users, if you want the free Nvidia share, you have to maintain the $2,000 for 30 days and make 3 separate buy trades. Lastly, there's also additional $18 cash coupon for you if you sign up using my link. Okay, back to the chart. As I was saying, for Tesla to stop its rot very minimally, it has to get above the 300 psychological level as well as the 61.8 Fibonacci level at 317. In fact, if you were to pull out my last video, I shared that if 317 breaks, Tesla could waterfall down to sub 300 at the very least, and it all happened. So now it's the opposite. Reclaiming 317 will unlock more upside. But as Tesla rebounds, we have to use a new set of Fibonacci level for better accuracy. So the first Fibonacci level is around 324, and now you have a range 317 to 324. A solid close above this area will unlock a lot more upside, which I believe it could bring us to 340's range at least. Okay, let's now have a look at Google's chart. As with many other big tech stocks, Google had a rebound last Friday. If this rebound is for real, there are 3 key levels to watch on the upside. The first level is none other than the 200 moving average. This moving average has proven to be a very strong support level for the last 1 year. So for Google to reverse the bearish trend, it needs to quickly get above this 200 moving average at around 176. The next level to watch is 182, which used to be a resistance level in the past, and this means it could potentially be a resistance level once again. And then the third level to watch is 187, marked by the 50% Fibonacci retracement level. This is the final level that the bulls need to get above to confirm the reversal of the bearish trend. In fact, if somehow Google can close above all 3 levels in the next 2 weeks, I think there is a decent chance for Google to start filling that huge gap between 192 and 202. It may not fill it entirely, but I think high 190s range is definitely possible. On the other hand, as long as Google is below the 2 levels, 187 and 182, I would say Google is still bearish or at max in a consolidation phase. And if we have some negative news this week on AI, tariffs or geopolitical tensions, then I think there is a chance for Google to break last week's low of 166.77 and fall towards that green support zone that I have drawn. That's the low 160s range. Moving on, let's check out Meta's chart. Okay, despite the recent decline from around 741 to roughly 641, a 100 points drop, there is some positivity to take away from the chart. Basically, the bulls have managed to protect 2 very important levels, 660 and 641. Can you see that 2 long wicks on the chart? So what happened was that Meta dropped to 641 during intraday on 2 occasions, but bounced back up by the closing hours. This 641 is actually a critical level where the 61.8 Fibonacci retracement level sits, so bulls had managed to protect this level. That's good. And then, do you remember I always share that if the main trend is intact, then the retracement should typically not go beyond the 50% Fibonacci retracement level. Well, as you can see, Meta has been trading at this Fibonacci level for the past 4 trading days, and it managed to close above it last Friday. That's another good news. And oh, one more thing, Meta is still above the 50 moving average, which is a positive sign as well. Okay, before you get all too excited, I must say Meta is not entirely out of the woods yet, because we are still floating near this 50% Fibonacci level, which is 640. Meta can lose it anytime, and if it does, then obviously the 61.8 Fibonacci will be the last line of defense. If that breaks, all hell will break loose. On the other hand, if we want to call Meta bullish, I think we probably need to get above 700 again. A solid close above that 23.6 Fibonacci level at 703 will be more ideal. When that happens, I do think bullish momentum will continue to bring Meta back to near all-time high at 730's range or break the all-time high. Let's move over to Microsoft. Wow, Microsoft is looking dangerous and yet straightforward. For the longest time, I have said that 385 is a very strong support for Microsoft. True enough, it went near this level last week and bounced off it again. This is the 3rd time it has tested and rebounded, which means if 385 breaks, it's very bearish and it's waterfall time. So there you have it. That's the bearish thesis. Very straightforward, right? As for the bullish thesis, we need Microsoft to stay above this green line for a couple more days. This line sits at around 396. So last Friday's close above this line is positive, but yeah, we need more days above it, preferably with volume to show that buyers are coming back. But for me to call Microsoft bullish, I think it's a long way to go, man. Can you see that huge gap? Yes, if we can ever get there in the next 1 or 2 weeks, then it's very bullish. But it's a super long shot, and I think it's unlikely for me to call Microsoft bullish this 2 weeks. I could be wrong. Anyway, before we hit the gap, maybe, just maybe, let's try to get above 404 or 405 level first. Then we will talk again. Alright, let's now check out the AI darling Nvidia. If you could recall, last week I mentioned about a potential post-earnings 8.5% movement. Well, Nvidia fell 8.48%. Anyway, I'm not gonna claim any credits because I took this number off this Options AI website. Okay, so one day after that 8.5% plunge, I like how the share price bounced off the red downtrend channel. Remember, I always said this, a retest and rebound is bullish. For confirmation, we need to see Nvidia closing above the 200 moving average, which now sits at 127. Above 127, I think naturally it will unlock more upside towards the 50 moving average at around 133. Given that earnings are out of the way, my personal view is that if Nvidia can reclaim both the 250 moving averages either this or next week, we could finally break above this purple downtrend line. And when that happens, it's obviously bullish. That will easily send Nvidia back into the 140s range again. But then, if the market receives some nasty news from President Trump and his related tariff plans, or if the geopolitical tension between US, Ukraine and Russia escalate, Nvidia might test that downtrend channel again. And if Nvidia falls back into that channel, wow, I will be very excited because that will bring Nvidia below 110. Not financial advice, but it's definitely a very attractive entry point, much better than buying it at 140s range. Well, it's gonna be an interesting week ahead. Moving over to the options trading segment, quite a number of trades to update this week, 6 to be exact, which are all summarized on this screen. As you can see, I opened 3 new cash secure puts last week amid all the chaos and volatility. The first one is this put on Google, which was sold on 25th February Tuesday, with a strike price of 160. The contract will expire on 4th April. There are 2 main reasons why I made this trade. First of all, Google has hit the 200 moving average, which is a very strong support level, something that I shared in the technical analysis segment. Next, the 60 RSI has hit the oversold level, hence I was of the view that a bounce was imminent in the near term. Okay, not gonna hide my trade. The trade is currently sitting on a paper loss as Google continued to fall for the rest of the week before a late rebound last Friday. Let's see if Google can close above 160 when the contract expires on 4th April. The second new trade that I made is a cash secure put on Tesla, which was sold on 27th February Thursday with a strike price of 200. The contract is also expiring on 4th April. The reasons behind this trade are pretty similar to Google's, but this trade has stronger conviction and confirmation. First of all, Tesla was hitting the 200 moving average support level. Next, apart from the 6-day RSI, Tesla's 14-day RSI was also at oversold level. Last of all, the candlestick has fallen out of the lower Bollinger Band. Given all these indicators and with Tesla being very beaten down already, I again was of the view that a bounce was imminent. Well, unlike Google, we really had a bounce off the 200 moving average last Friday, and the trade is now sitting on a paper gain of about 20%. But of course, some may see Tesla as a falling knife given how it has been falling non-stop for the past 1 month. If that's the case, so be it. I don't mind getting a side with 100 Tesla shares at $200 strike price. Okay, third new trade is a cash secure put on Nvidia, which was sold on 28th February Friday with a strike price of $100. This contract also expires on 4th April. The thought process behind this trade was straightforward, which is my favorite word, overreaction. Basically, the market had overreacted to Nvidia's earnings a day earlier on 27th February. To be honest, its earnings are pretty strong. Therefore, that more than 8% plunge on Thursday was uncalled for. Furthermore, just like Google and Tesla, I see the 200 moving average as a decent support. And so I stepped in one day after that big decline. The trade is currently sitting on a paper gain of about 25%. Alright, I will combine the next two trades together. It's this cash secure put contracts that expired last Friday 28 February. One is on Apple with $200 strike price, so on 21st January, while the other is on Nvidia with $95 strike price, so on 27 January. The reason for both trades was again due to overreaction by the market. On 21st January, Apple gapped down on 3% due to double downgrades from Jefferies and Loop Capital. And to rub salt to the wound, JP Morgan slashed their target price for Apple. As for Nvidia, on 27 January, it was the fateful day where DeepSeek was announced, and the market panicked, overreacted and started to dump loads of Nvidia shares. As a result, Nvidia gapped down for 17%, lost nearly $600 billion in market cap, and clocked the deepest single-day loss for a company on Wall Street. Anyway, both strike prices would not breach from the point I sold the contract's due expiration date. As a result, both put contracts expired worthless and I managed to get a total profit of about $300. Okay, final trade. It's this cash secure put on Tesla with a strike price of $300 and was set to expire last Friday 28 February. At that point, Tesla was trading below $300 and I didn't want to accept the assignment of Tesla shares at that strike price. Hence, I decided to roll out and down for the contract. With that, the new expiration date is 21st March and the new strike price is 272.5. If you don't know what's rolling a contract, you can check out my options video linked at the top. As we enter the new month of March, Wall Street and investors are looking for signs of recovery following the recent market sell-off. However, numerous challenges lie ahead, ranging from a slowing economy to renewed tariff concerns, persistent inflation, and escalating geopolitical tensions. Since I have discussed many of these macro factors in my previous videos, I will not go into the details again for this one. But I want to highlight a relatively new major concern that is weighing on the markets, which came out from the recent earnings seasons. That is the level of spending on AI data centers and capital expenditures on AI technologies. To put it simply, given the weaker than expected forecast by the various tech giants in their recent earnings calls, investors and experts are raising concerns about potential overspending and the need for clear ROI matrix to justify the high costs involved. And on a related note, the news from Chinese AI startup DeepSeek in late January has added to the uncertainty surrounding the huge AI investments. This, combined with the fear of an economic slowdown, has led to a sell-off in many of the big tech stocks. Investors are basically shifting away from these volatile and so-called high-growth tech companies towards more stable investment options. Anyway, in the very near term, at least for the upcoming 1 to 2 weeks, I would think a lot of emphasis will be placed on two things. First, it's the latest renewed geopolitical tension after that heated verbal exchange between the US and Ukraine presidents. Second, it's how the affected countries react to Trump's tariffs when they take effect in March. For example, China has vowed to retaliate with all necessary measures in response to Trump's proposed tariffs. This is definitely not good news, as it signals a potential escalation in the global trade tensions. Okay, but all that said, despite the turbulence, the broader market remains near its all-time high, which was reached only about 2 weeks ago. Sure, we are in extraordinary times right now, and sure, volatility is going to remain elevated, but I personally see this as a decent opportunity to buy the dip amid the chaos. But that's just my perspective and not a financial advice for you, because the dip could go even deeper, which is why I always buy in tranches to manage my risks. Okay, overall, while the macro risks remain, the broader market fundamentals, including the strength of the US economy, AI-driven companies' growth, and a cautious Federal Reserve, do suggest that the bull market remains intact, at least for now. I really do think that there are opportunities for investors who can navigate the volatility, though it may be challenging for newer investors who cannot stomach the volatility, or those who bought at all-time highs a few weeks or months ago. My personal take is, stay focused. While short-term swings are inevitable, staying focused on fundamentals could prove rewarding in the long run. And oh, before I forgot, I stepped in to purchase some Google and Microsoft shares last week. Not a financial advice, of course. And how about you? Are you buying this dip? I would love to hear from you. And don't forget to tap the like button before you exit, alright? Thanks a lot.